Guys, Derek Whitaker. Welcome to this presentation by Blu Sky Factory. Super excited that you are here and really want to dive into some of the mystery, unveiling some of the mystery of the stock market and particularly stock options trading and volatility. A lot of people are asking me about volatility, of course, because the markets are up and down and they're all over the place and a bit of a shake-up is going on. And what's your perspective on it? Well, I see it as a perspective of great opportunity, and I just want to dive into it with you for a little while on how to potentially make profits safely in volatile markets. That's the name of the presentation for today, how to potentially make profits safely in volatile markets. Before I start, though, we need to tell you up front, we're not a licensed financial planning, accounting, or law firm. We're simply an education company who give you factual information. We do not give any general specific advice around finance, business, investing, options, trading, or anything else. That's not what this presentation, of course, does. Please see a licensed financial planner when it comes to any investment advice you need. Just as a bit of a side note today, because I think there's a lot to unpack in this, 10 things I wish I knew before I placed my first trade. You know, there's always the value of hindsight. And you look back and you go, well, if I'd known that, that would have accelerated my results. And today I want to kind of package that together for you so that you can accelerate your learning as we go. The first thing I wish I knew before I placed my first trade was that trading is all about risk management. Okay, it's all about risk management, which is a bit of a change in thinking in terms of mindset. And I'll tell you why. Because an entrepreneur looks at risk in terms of, hey, how can I build wealth? They will take risks that in terms of putting the next generation's fortune on the line in order for their business project to be succeed. You do that in trading. You are asking for it. You're absolutely setting yourself up for problems. And that's because the market is a very unforgiving kind of kettle of fish, unforgiving business if you get it wrong. And it's a different headspace. It's one more of protection. We know as a trader what the upside might be. What we've got to consider is the downside. If this goes wrong, if this doesn't happen and play out the way that we would like it to, then really we've got to calculate that. What's the max risk here? And the beauty of what I do in terms of stock options trading is you can actually get very precise and calculate how much risk is on the table before entering the trade, and then decide whether or not you're happy with that risk versus the potential reward that it could offer, which is a very different approach when someone is just compared to someone who's just buying stock and hoping that it'll go up. So keeping your eye on risk is absolutely crucial, because there's one thing that may happen. The markets can change very quickly. And as a trader, you've got to be aware of that. You've got to be on par. You've got to be on your toes in terms of that occurring. The other thing about trading, if I wish I knew, was that 80% of trading is mindset, 20% is technique. So the actual execution of the trades, the research, the systems that go in place that you put in as a trader, that's all very technical. That can just be done. But the real work is done up here, what goes on between the ears, and how you interpret things, how you see the markets and what's going on in the world, what the market is doing at this time, what political influences are happening. That really comes into play, particularly when a trader is up against the wall, when the trade's not doing what they want it to do, and they're having to manage that risk. That separates good traders from bad traders. Look, I'll take the easy profits and winning profits every single day. We're bang, throw it on, goes the way I want to, happy days, right? I say to my students, though, I don't really learn a lot from that. Really learn when it doesn't go the way I want it to. That's, as a trader, an opportunity to increase my expertise. And that's how you've got to look at it for someone who's aspiring to go down that path. What goes on here, how you interpret it, and how you manage loss is really critical in relation to this. I remember my first mentor, he said to me, Derek, if you can learn to accept a loss, you'll be a great trader. And I looked at him, he should have seen he probably saw the look on my face going, I'm like scratching my head going, what on earth are you talking about? And he said, let me put it to you this way, Derek. Let's say you put on 10 different trades, okay, at the beginning of the month. And each of those make $1,000 at the beginning of the month. 2 of them go wrong during that period, okay? And they cost you $2,000 each. Are you still ahead for the month? I did the calculations and it worked out, yeah, okay, you're $6,000 ahead. He said, exactly. He said, that's the whole point. He said, if you can learn to accept those losses, you'll be a great trader. In other words, it's managing the risk, it's managing how to handle it and interpreting loss as it comes around. Trading is a different mindset than investing. Knowing how to exit is more important than an entry strategy because the end result defines the setup. Now, what do I mean by all of that? Typically, an investor buys something, holds onto it, and hopes it goes up over time. A trader is a very different mindset. Okay. I'm looking to get into the market and get out. And the model that I like to use is kind of like the owl in the tree, right? Sitting there on the branches going, hoo, ancient wisdom, observing and looking down at the madness of Wall Street, the greed and the fear that is going on, and realizing, you know what? I see an opportunity in the market. I launch myself off that branch, swoop down, take that profit, and take it back up to the tree, right? And enjoy the spoils of it and get out of the markets. I want to get in and then I want to get out. And that's the whole thing. So I realized very quickly when I was working in some high-end law, accounting, financial planning firms, when a client has fallen in love with their shares, right? If they were starting to tell me things like, I've met the CEO, boom, alarm bells would go off in my mind. I've checked out the company, it's doing this, it's doing that. And I'm going, okay, this is an investor mindset. They're thinking, how can I get in when it's really low and watch it go through that growth period? As a trader, I don't really care. I'm looking for companies that are pretty much established. And what I'm doing is I'm defining the strategy that I want to use. So what is my objective here? Am I going for cash flow? Am I going for leverage? Am I trying to protect a portfolio? Am I wanting big explosive growth? Am I wanting to embrace volatility? Those questions will define the strategy that I do. And then the strategy will define which stock I get into to apply it to. So to totally shift and turn around a mindset as opposed to the investor who's trying to buy something and go for that growth. Additionally, as a trader, I can actually sell something before I buy it. Now, a lot of students, that messes with their head, that whole concept. It's kind of like this. The easiest analogy of that is, let's say I'm an entrepreneur and I am an entrepreneur, but let's say I decide that I'm going to provide high definition televisions to the market. All right. And I go online and I find a manufacturer overseas who can do it really, really cheap compared to what I can buy it for retail in the stores locally. So what I might do is set up a website. And basically, instead of, let's say I need to order, the minimum order from this manufacturer is $250,000. Let's say I don't have $250,000 to do that. So instead of risking $250,000 and getting a loan from the bank, all that sort of stuff, what I might do is start selling before I buy them. So I set up a website and I start selling and saying, listen, it's going to be 60 days delivery before you're going to get your television, but you're going to love it because it's going to be able to do this. And I sell them out. They go like hotcakes, right? At a really great price. I go to the manufacturer with that money and then I order them, right? They get made, I ship them over, and then I deliver them. So what I've done is I've sold before I buy. I've sold at a higher price and bought them at a lower price. That's kind of the metaphor you can use when it comes to the market. We call that shorting the market. So it doesn't matter which direction the market goes in, it goes three directions, up, down, or sideways. I can potentially profit from those movements as they go, which is a very different mindset from the investor mindset. Another great philosophy here, or thing that I wish I knew before I placed my first trade, it's easy to get into a trade, but it's how you, more important to know how to mitigate it when it doesn't go your way. All right, inevitably, something can go wrong. The market doesn't do what a trader expects it to do. And how do I manage that? Okay, I can set it up beautifully, everything work out perfect, but those adjustments, I need guidelines to basically get me through when it goes wrong. I need to be able to make adjustments to protect my capital, to protect my risk when doing so. And that's really key to understanding when approaching this sort of thing. And I'll spend more time with my students who come to me and say, hey, Derek, can you teach us how to do this stuff? Because, obviously we trade for private groups and we're often approached by people, can you teach us what you do? We'll spend more time when teaching this on how to get out and when it goes wrong and managing the risk, as opposed to the setup and getting into it. Really important to understand. The fifth thing that I wish I knew before I placed my first trade is a trader needs to be greater than a one-trick pony. I've seen a lot of educational courses out there, and they'll sell one strategy for $5,000 to $6,000. That's great, but the problem is when the market changes, that strategy is useless to that student. They don't know how to manage it. They only know how to do one thing and one thing alone, and they don't have the flexibility to apply the theory of a different strategy over what they're doing. So I'll give you an example. When a trader gets quite sophisticated, what they can do is apply the knowledge of a different strategy to what they're currently doing in the market. One of the things that we do for our advanced students is we look at how to multi-layer a strategy. So what we do is we take a 5 to 6% risk in the market. So we can do something like buy shares. This is one example, one hypothetical. We can buy shares, capital guarantee that that whole share portfolio is safe, all right? That if the market crashes, we basically will get our money back at the guaranteed price that we've locked in. Okay. And it's contractually binding. It's not a stop loss or anything like that. It is contractually binding. We've guaranteed it, legally binding at this rate. And what we do is we'll take a 5 to 6% risk with that kind of metaphoric insurance in mind. Okay. And what we'll do is we'll have 16 different adjustments we can make to reduce that 5 to 6% risk so that all you're left with at the end of it is a free bet. Okay. What we want to try to do is get the trade to a free bet status with that 5 to 6% was off the table. How many like a free bet in the market? So you could have, imagine having 10 positions like that, where 8 of them perhaps, make a little bit of profit and you kind of scratch it and make a tiny loss or something like that. No big deal, right? It doesn't put you out. But there's 1 or 2 that just go bang, go gangbusters and shoot up. That can really change how an account balance, it can increase it big time when you get that right. And so that's one of the ways that we look at the market and going, all right, let's hedge our odds here, hedge the odds, or hedge the bets, so to speak. And let's get to a point where we can actually take advantage of any of those big movements. Now, to do that, you've got to know more than just one strategy. You've got to have multiple tools in the toolbox to be able to apply that to the right application. And that's one thing I wish I knew before I placed my first trade. The sixth thing is a trader must be disciplined but flexible enough to adapt to changes in the market. One thing's guaranteed in the market is change. Okay. So you've got to be disciplined to have your guidelines. This is how I mitigate it. This is what I'm going to do. But also understanding that, you know what, circumstances could change here. And I may need to have that flexibility. I'll give you an example. In 2022, there was something that we were doing. We were looking typically at 6 to 8 weeks expiry before a contract would be done. All right. So we were looking at getting in the market and being in that trade for 6 to 8 weeks. Suddenly, in the beginning of 2022, that's not working as well as we would like it to. So what we did is we took a 12-month approach to it, okay? And that adjustment made a big difference, allowing the market more time to move. Come 2023, that strategy, that adjustment wasn't quite working. So what I did with the students is let's go back to fundamentals again of terms of the guidelines of what we do as far as trading is concerned and see if that works. So I said, that's what I do in this situation. They're going, what do we do in this situation? Well, it's not quite working. I said, well, when I'm faced with that situation, I go back to the basics again and go, all right, what worked? And go, will this work now in this time? And sure enough, going back to the original expiry of 6 to 8 weeks was worked. And that's where you've got to have that flexibility to go, that small tweak, that small adjustment can make a big difference in terms of getting results. So that's really important to understand as a trader. It may not be earth-shattering what you're doing, but that small tweak can make all the difference in terms of results. Number 7, the thing I wish I knew before I placed my first trade is a trader must always be learning. And generally it goes this way, deeper rather than wider. Okay, there are so many what we call derivatives on the markets. that can be explored, and they're all very interesting. But typically what I found more helpful is getting really good at something that's working for you. All right. That works for me. And for me, it's options. One of the reasons I went back to options is I noticed that all the professional traders ended up going back there. All right. The guys who were really good at it, when I was working in those high-end law, accounting, financial planning firms, they'd come into our offices, and the guys who were doing it really, really well would generally come back to options. Thought that's interesting. Well, I'd rather get good at what they keep coming back to as opposed to chasing all the other things. Now, I'm not closed to other things, but in terms of learning and becoming specialized, that's really important. I'll give you another example. I heard of a trader who worked for the banks, and he only worked on one Forex pair, Forex being foreign exchange. And he would just look at that one pair. And he studied it, he knew it, he understood it, and it had to have the perfect setup before he put millions and millions of dollars on that trade to get the results that he did. So it means you got to be patient as well. And that was just how specialized he was. He'd only trade that one pair, knew that, and go from there. And generally, as a trader, you do that. If something's really working for you well, you'll keep coming back to that, keep coming back to it, because you just know it works, right? If something works, the old line, if it ain't broke, don't fix it type of thing. And that's typically how it works. But sometimes you have to have that flexibility, as I mentioned previously, to adjust things as you go within that narrowness. The eighth thing I wish I knew before I placed my first trade was understand the 3 stages of learning as a trader. Now, a great book on that is Trading in the Zone by Mark Douglas. You can get the audio book on that or order the book online. Terrific read. And Mark in that book points out 3 different stages of learning. So the first one being that a trader typically will copy what their mentor taught them to do. This was an interesting thing because when I was working in those accounting firms, law firms, that was the thing that we noticed, that the successful people who traded were generally taught by someone who did it previously to them. They were taught how to do it. They would get better results. And so I kept that in mind when designing these courses of that aspect. And when it comes to the first stage, generally what people do is they copy exactly what their mentor taught them to do, precisely, right? The second stage is they get a little bit more confidence and they start to branch out on their own a little bit. I'm going to try this. I'm going to try that. I'm going to try this or make this adjustment here. They're making their own individual decisions to get a result. And that's really exciting. And, it's kind of working it, and they're trying different things by testing things and trial and error. They're figuring it out as they go. And I see that with my students too. Once they get a bit of experience under their belt, a bit of confidence, they start doing that. The third level that Mark points out is one of mastery. So a trader understands things. He takes all the wealth of knowledge and experience that they've gained over several years, and it becomes instinctual to them that they know the market's about to do something, or they just sense that something could occur in the market. And they get in this, what he calls a zone, where they respond to what the market is doing, and they do it fearlessly. But their mindset, and one of the biggest takeaways from this book, piece of literature, is once I put a trade on, anything can happen. And that's kind of my philosophy too, as a market who responds to the market and trades the markets, is put it on with the best of my knowledge, with the best of my guidelines, but knowing anything can now happen. It's a great read. The ninth thing that I wish I knew before I placed my first trade was understanding the 3 factors that affect the stock market. Now, they primarily are these 3 things: politics, economy, interest rates. And I'll take you through a case study in a few moments to see how they interrelate and how they all connect. Those 3 things was something that I wish I knew, because I do the fundamentals. I was the investor mindset when I started in this game, and I would look at things and would go, all right, I've studied what this company does. I've looked at its business model. You can look at its earnings, previous earnings, projected earnings. You can look at its debt to equity ratios, all that sort of stuff. And you can buy the stock and it does exactly the opposite of what you hoped it would do. And I'd sit there scratching my head going, why? Why would it do that? And it's because these outside influences have an effect on what's going on in the market. Politics is a big one. Government can make a decision like this, and then the economy responds in relation to what politics has done. Then the economy is often gets ticking away or goes downturn, whatever it might be, and the banks look at it and go, all right, we need to adjust our interest rates to try and stimulate the economy or pull back the economy, whatever it might be. And I'm talking about the centralized banks, and in that sense, in the US market, that being the Federal Reserve, Australia, the Reserve Bank of Australia, they play a huge influence in terms of the markets, and we have to price that in to what we're doing as far as our trading is concerned. The other factor that I wish I knew before I placed my first trade was that the different types of trading, there are numerous sorts of derivatives to trade. There are four primary ones that I've seen. Obviously, stocks is pretty standard. Most mum and dads are buy low, sell high. If they're doing anything or dabbling, it's the stock market. There is the foreign exchange, or Forex, as we call it. Huge market. To give you an idea of the liquidity of that market, how big it is, $1 trillion is traded in one day alone across the world on the Forex market every single day. That's a lot of money. It's very liquid. By liquid, we mean there's a lot of volume going through in terms of trades, which makes it more attractive when there's volume there for traders. There's commodities and futures. They're related to raw materials like oil, like gold, like silver, even agricultural stuff like wheat, skinny pigs, coffee, all that fun stuff. They're doing that. Futures is typically on future prices, okay? And then there are what I like is options, which is probably less known, but when you discover these things, you just see how powerful they really, really are. Obviously, crypto is something that's come up in the last few years and grown in popularity. Crypto is more of it's a smaller market than the stock markets. So it's been a long time for the stock market to actually look at that stuff, one, because of regulation, but two, because of liquidity. When you've got hedge funds putting on, multi-million-dollar trades, they want to be able to have the liquidity to be able to pull it out and get out. They want the ability to do that. And the volatility of crypto sometimes makes big hedge funds nervous, and I can understand why. So they see it more as a speculative play. And speculation is interesting. I like what Dr. John DeMartini said, that if you're going to speculate, you should never put more than 10% of your net worth on a particular investment or trade. And he says, because most people can handle losing 10% of the wealth. More beyond that 10%, it really sets them back. It really makes them nervous and messes with their psychology. So in terms of the stock markets and derivatives, those are the ones that I primarily looked at. I want to dive into options, is what I do, and I'll go into why I look at those. Just a little bit of history on options. They commenced trade on April 26, 1973. So they've been around a long time, okay? Almost, 50 years. So when the Chicago Board of Options Exchange, CBOE, started trading over 16 various stocks. So something's been around 50 years. It doesn't look like it's going to go in a hurry. You can actually do options on crypto as well. The rules are different. And in my view, they're probably not as liquid as what you can do on the stock markets. But nevertheless, that's how widely accepted options are. And what occurred was, back then you generally had to trade an option over the precise amount the stock was trading at. So if the stock was trading at $25.34, it was difficult to trade down an option during that time. It was relevant for whether it be 6 months and 10 days, 95 days, 65 days, or 35 days. So what they wanted to do was standardize it so that everybody could agree on something. So if you've got an ABC stock trading at $20, right, you could buy it or trade it at $20, or the next one up at 21, 22, 23, or not $20.23, not that awkward price point, and vice versa going down, 19, 18, 17, etc. They wanted that standardization in there where everybody understood, hey, this is what the contract is, and allowing people to get out of that contract if they wanted to. This is with the beauty of the US market. It's not like this on every market, particularly like the European. The European's different. But the US market allows someone to buy or sell before expiry of an option. And I'm going to get into what an option is in a moment. It'll make more sense what I'm saying in just a moment. But as I mentioned, it was difficult to find a buyer over an awkward price point and time period, and the investor would have to wait till the options expired. So CBOT, or the Chicago Board of Trade, they standardized the over-the-counter market soon after putting in fixed prices and fixed days of expiration on contracts. So you might be wondering, all right, well, that sounds all great, Derek, but what actually is an option? I don't quite understand that. So let's get back to the very fundamental understanding here. And there's a lot in this. I'm going to repeat it a couple of times so it sinks in. Options are a financial contract. It's powerful there, a financial contract to buy or sell a unit of shares over a certain stock at a specific price point during a defined time frame. Let me go over that again because I know there's a lot there. Options are a financial contract to buy or sell a unit of shares over a certain stock at a specific price point during a defined time frame. So let's break that down. A financial contract. Okay, this is more powerful than what we call a stop loss. You may be familiar with stop losses. This is legally binding. It's contractually binding. And it's important to understand that. And so what you can do is metaphorically insure shares, okay, that if they were to crash, you can basically, let's say ABC is trading at $20.20. If I bought insurance at $20, right, and the thing crashed to 10, I have protected that portfolio. I might lose 20 cents because I got in at $10.20, but the rest of it, that extra $10 is guaranteed. I can over-insure it like you do with cars, right? You have agreed value instead of market value. I can do agreed value. I can over-insure it. I can insure it for $21. I'll pay more for that, but I can be done. And it gives me the option to buy or sell a unit of shares. So it's over a particular unit, over a certain stock or derivative at a specific price point during a defined time frame. Now, the time frame is important, okay? Because what it means is it will get a result. If I'm trading this 6 to 8 weeks out during this before expiry, I know in 6 to 8 weeks whether this is going to be a successful trade or a losing trade. Now, that's powerful when you think about it compared to the mum and dads who buy a stock, hope that it goes up, and they hang on to it and hang on to it and hang on to it forever. And 5 years later, this thing still hasn't moved and they're still hanging on to it, right? That's kind of the investor mindset. And that's great, but it's bad in the sense of you're losing money on it, right? and so it's really, really important to understand that that defined time frame forces a trader to get a result. And that's what we're after, is consistent results over time. So make a winning trade, do it again, make another winning trade, do it again, make another winning trade, do it again. And that is giving cash flow, but it's also reducing the original capital traders put up so that then they get to a point where they're trading from profit. And that shifts their psychology, right? That shifts their psychology to take greater risk on profit as opposed to original capital. And that is a great place to be set up in when doing this sort of thing. The next part I want to look at is the stock market was originally designed to raise capital for a company. So many big corporations started with very small, humble beginnings. For example, iiNet, one that's very well known in Australia, was a company that started with a few servers in someone's garage. There's McDonald's, there's Apple, Dell Computers, through to Walmart. They all had very humble beginnings. So no matter how you feel about those particular companies, it's important to realize that small beginnings are important. And you may be on your own wealth journey thinking, well, who am I? I'm just a small player here. But that doesn't mean you'll stay small, okay? That's important to recognize. And sometimes just faithfulness at being at it and showing up for work and showing up for learning something new and just keep trying, keep trying. If I had quit in terms of my journey in trading, I wouldn't be sitting here doing what I'm doing now and talking to you. So it's important to just keep going and keep going and keep going. And that's really important to understand. But also recognizing that things change and things grow. But they've needed, in this instance, other capital floating on the stock market, other capital to grow to the size that they have. Traders trade options for these reasons. Number one, income. So they're just trying to build an income and that be something they live on. Hedging, protection. Okay, they've got stock they want to protect. And number three is leverage. They can get huge results from that. Now, let me dive into leverage a little bit for you. Leverage is like this. Leverage let's say you go on holidays and you see a beautiful farm, okay? Um, it's great, but you can tell reading between the lines that the farmer's had a few rough years. And the farmer has recognized that his children don't want to take over the farm. They don't want to carry it on to the next generation. He's getting on a bit in age, and he's kind of looking for an exit strategy. He's going, I don't want to work this hard for the next 20 years. I want to start slowing down. So he's looking to get out. You kind of on holidays, you find out the council's got huge plans for this place, and you're looking at the farm and thinking, you're not thinking farm, you're thinking golf course, okay? So you might go to the farmer, and he's had his farm valued recently, let's just say for $1 million. And you say to him, listen, here's what I'll do. I'll pay you $100,000 up front today for the right, but not the obligation to buy your farm for $1.1 million over the next 10 years. Farmer thinks, great, it's a good deal for him. He's getting $100,000 up front, which he didn't have. He can improve some things, buy some new equipment that he needs, all that sort of stuff. And he has hope that there is some exit strategy there that the investor might want to do. Why is it a great deal for you? Well, you're locking in that price. Okay, you've got 10 years for that thing to grow. And instead of risking $1 million, you're only risking $100,000. Now, let's say in 5 years, that investment goes up and doubles in price. Well, guess what? Your option now is going up in value because it controlled $1 million before. Now it's controlling $2 million. Okay, so you just doubled your value of your option there from 100,000 to 200,000. You've also written in that contract that you can on-sell that contract to someone else if they want it. So you could, if you don't want to hold on to it and develop it, your plans change, you can go sell it to someone else who has that vision or wants to buy a farm. Okay. You could also raise in that period, it gives you time to raise funds to do a development where you can buy the country club and do the golf course and all that design, etc. Gives you also time to see how it's going to play out in the local community. So that's the power of the options. Instead of risking $1 million, you've only put 100,000 on the table. And that's where the leverage comes in, because suddenly if it's doubled in price, so is your option. For a small outlay, you're controlling a greater valued asset. And that's what options do. On the US market, one option controls 100 shares. Traditionally in Australia, one option would control 1,000 shares, but now they've scaled that back to 100. You can do 100. You just have to check out 1,000 or 100 what play you're doing it in, which one you're doing it in. But that is powerful when looking at these instruments. The hedging protection, real sleep at night factor, okay? If something crashes, you know that you've locked in the price and the portfolio is there. But conversely, you can also do that to protect an option play, okay? That if it goes against you, you've got protection in there. And the other one is income. The easiest way to think of income is guys who buy stock for their dividends that pay out every quarter or every year, and they're just wanting to collect that premium. You can do that with options. You can do that on a weekly basis. You can do it on a monthly basis, a yearly basis, whatever it might be. However, the strategy is going for that trader. And that's what makes these so powerful. The other thing that you can do is understand the different dimensions of trading. I really wish I understood this before I placed my first trade. The first dimension is very typical of mums and dads. It's buy low, sell high. They get a tip and they think this might go. This is the investor mindset, and they want to go from there. Buy low, sell high. The second one is directional strategies, all right? It's not so, I've made an error there. It's not income-based strategies, but it's directional. As I mentioned before, the market can only move 3 directions, up, down, or sideways. And these traders are trying to guess what it's going to do next. It's an educated guess. They often use technical indicators to do so. And they're looking at all these fancy instruments that have all these big, complicated mathematical computations, which the computers do for them. The brokerage landing platforms have that. And they're trying to work out, is it going to go up next? Is it going to go down next? Is it going to go sideways? The third one is time-based strategies, income-based strategies. I'll just explain that one, where basically it's like the dividend collector, collecting that premium over time. You can do that with options on a weekly basis. How many like to get paid weekly? You could do it on a fortnightly basis, monthly basis, whatever it might be. The fourth dimension is definitely the most favorite amongst our students. And this is what we call non-directional, and it's leverage. So basically, It's putting on a trade and not knowing whether it's going to go up or whether it's going to go down. All right. So you could do one or two things, go up or go down. And the great thing is, if you think it's going to go up, knowing that, even if you get it wrong, you still potentially could make profit is a really cool thing, right? We get over the ego of I got it right, I got it wrong. Because I've noticed with those who are directionally based, they can very much, and I've done directional trading myself, it's great when you get it right, and you can get it right, 80% of the time. But when you get it wrong, it can really eat into your profits and hurt. And so, especially if the market keeps moving against you, moving against you, moving against you, moving against you. So that's the power of being in a fourth dimensional play, is don't know what it's going to do. Don't care as long as the thing moves. And it's seeking volatility. It's going in and embracing that, going, where is the action? Where are the scary headlines? Where are where's the greed? Where is the fear? I want to embrace that. So that's really, really powerful. I love what I've had 3 mentors over my trading career. And the second one told me this. That scenario where traders are walking around and they're blaming the market, saying, oh, this market is terrible, it's shocking, et cetera, et cetera. He said a golden nugget that I'll never forget. He said, the problem is not the market, the problem is the strategy is wrong, okay? It's not that the market is wrong, it's the strategy that is wrong. And when I understood that, it really took the responsibility from, hey, blaming the market, to going, you as a trader have to work on the strategy. If the strategy isn't working, there's a problem with the strategy. And that's a really key difference in terms of the understanding and approach to the market. So in summary, the 10 things I wish I knew before I placed my first trade. Trading is all about risk management, number 1. Number 2, 80% of trading is mindset, 20% is technique. Number 3, trading is a different mindset than investing. Knowing how to exit a trade is more important than an entry strategy, because the end result defines the setup. It's easy to get into a trade, but it's more important to know how to mitigate it when it doesn't go your way, doesn't do what you want it to do. Number 5, a trader needs to be greater than a one-trick pony. Number 6, a trader must be disciplined but flexible enough to adapt to changes in the market. Number 7, a trader must always be learning deeper rather than wider. Number 8, understand the 3 stages of learning as a trader. Number 9, 3 factors that affect the stock markets, the politics, the economy, and the interest rates, and then the different types of trading that exist. That's the 10th thing, as far as the 10 things I wish I knew before I placed my first trade. So I hope that's of value to you for those who are considering getting into this play. There's 7 to 8 years worth of education right there that you've received in 30 minutes or so. So I hope that's of value to you. What's happening in the markets? Well, let's have a look at a 5-year chart from 2023 backwards, and you'll get an idea. What we're looking at here is 3 different indices. Indices are simply a grouping of shares, and they measure them as a collective whole. So the S&P 500, you can see in the dark blue, that's the top 500 companies in the United States and the US markets. The NASDAQ composite, the NASDAQ is the technology sector. So they group all the tech shares together. And then the Dow Jones is made of 10 very big companies, and they group those 30 together. If you ever heard the Dow Jones be quoted on the television reports, that's what's going on there. And it's comparing what's happened over the 5 years. Yes, they have grown, and they're at nosebleed heights, okay? They're at big highs when you consider the market overall. You've got to remember, in around 2018, 2019, Donald Trump was the big political influence here. I'm going to use this case study of how politics, economy, and interest rates kind of run together. And he was a president. When he got into office, the market went, yay, we've got a Wall Street guy in charge of the country. And it was buoyant, it was positive. And remember, it was coming out of a recession the United States had through the Obama administration. Democrats had come out of the global financial crisis in 2008, 2009, and Trump was determined to get Americans working again. So what he did was he passed tax breaks and laws for companies to basically reduce the company tax rate. That was the first thing he did. And the second thing he did was he gave a holiday period for big companies who had money offshore outside of America. He says, what I'll do is I'll give you a tax break holiday. We'll reduce the money it takes to bring that money back into the country, reduce the percentage, but you have until this date to bring it in. And he wanted to do that to bring money back into the economy, to get Americans working again. Well, the markets loved it for him. The economy loved it for him. And what do you know? Real estate starts going up. Businesses start employing more people. They start improving infrastructure in their companies, hiring more people. And then as a result of that, the real estate market starts responding and going up. And everything's hunky-dory. Everything's going on fine. Inflation starts to kick in because there's more money afloat, things get more expensive. And so the Federal Reserve stops and says, well, hang on a second, we need to, and it happens around here. Okay, so 2018 gets off to the flying start. At the end of 2019, it starts going, well, hold on a second, this is great that you've had this rise. However, we're concerned about inflation, so it raises interest rates. And bang, you get this wobble in the market here. It went down a bit. And it's like, okay, Trump was not happy that the Federal Reserve did that. He wanted to get the economy moving. And a lot of his success in terms of the markets, he was hoping what he could do for the economy would get him re-elected for the next election. Not getting into the whole political situation of January 6th and all that the Democrats did, but we see this major wobble happen. Things started climbing in the beginning part of the Biden administration, went up, and then you get this wobble here. This is when COVID happened in 2020, all right? In March of 2020, the markets absolutely crashed. We as a trading group made an absolute fortune in that crash because it went down and kept going. And you can see how big that drop was. And it was really interesting sort of perspective. I had moved into a new place at that time. I was only planning to stay there for 3 months, and then COVID happens and we're all in lockdown. So that plan went out the window. I was actually looking at only moving overseas. So I only wanted a 3-month arrangement. And I remember being in lockdown, and my neighbour's there, and he's working on his garden. We start having a yarn over the fence, and he hadn't met me yet. He says, oh, what do you do? And I said, oh, I trade the markets and that sort of stuff. He said, oh man, you must have had a really rough week. And I said, no, we've done really well. I didn't tell him how well we did, but we've done really well. And it's a really weird feeling when everybody's fearful around you of the unknown, and you've absolutely cleaned up on the markets. So that was interesting. Then you see the NASDAQ here absolutely take off. This is the tech sector, and you can understand why, because everybody's staying at home in lockdowns. They're renewing their Netflix subscriptions. They're ordering things online with the stimulus checks they've got. That sector just absolutely goes off because it's one industry that can still function while everybody's in lockdown. You can see why it pulls away from the S&P 500 and the Dow Jones there. Then it takes a curbing after everybody comes out of lockdown into 2022. So you can see it from 2020 to 2021, tech sector's going crazy. And then it starts cooling off, all right? And you start seeing the Twitter files come out. You start seeing the investigations, that the reports that the FBI and other agencies were using those platforms and looking into companies, and trust in that sector absolutely plummets, and people start canceling Netflix subscriptions and this sort of stuff because they don't want them anymore. And what happened in the meantime was that the Democrats really had it out for fossil fuels. They were pushing this climate agenda, and in my view, the world was not ready, to go to electric vehicles full time. It passed rules that were like, Congress was saying, we're going to give billions of dollars away for those who go into green energy. And the oil companies are looking at this and going, hang on a second, if we don't pivot here, we're going to become dinosaurs. So you have these oil companies then starting to get into trying to latch onto these electric vehicle contracts, and the motor vehicle industry starting to get into electric vehicles and lithium production, all this sort of stuff, totally moving away from fossil fuels. And you even had companies doing deals with, Starbucks, with recharging stations, that you can get a skinny latte while your car is out there charging. And you had the oil in the ground in the United States. It was sitting on it, but the oil companies weren't refining it. Okay. They moved to getting into this new technology. And so when oil prices is scarcer, that price went up. You recall that the oil price went up. When that happens, that has a flow-on effect of costing more to transport goods. And we had a thing called inflation kick in, and it went hard globally across the world. Supply chains were being disrupted because of the lack of oil. Cost of doing things was going up. And of course, as a result of that political decision, the economy responds. And then, of course, the Federal Reserve starts hiking up massive rates, interest rate after interest rate after interest rate after interest rate, trying to beat down that problem with inflation. The problem with that was, with interest rates, is then it affected the bond market. And banks love bonds. Bonds are IOUs from the government. And what they were doing was basically a lot of the banks, particularly the ones that were in the Silicon Valley type thing, where the companies were wanting to draw funds out because they're having to do massive payouts to different companies. And, you know, they were sacking staff. Then there's a run on the bank, and they've bought these bonds at prices that they have, the bond price face value has actually increased. And of course, it just became a deck of cards starting to implode in the markets. So this is the big concern in the markets at this point, when banks are failing and you've got bond prices doing this sort of stuff. It's a real mess. It's a real mess. But that real setup of mess is something that is creating opportunity. This is where we see that, because uncertainty leads to volatility. And volatility is something that we embrace. Volatility is something we are after. It's these black swan events like COVID-19, flash mobs, September 11, which causes uncertainty in the markets, which leads to volatility in the markets and greater opportunity when a trader is trading, for those who are embracing volatility. And that's what we teach our students about, how to embrace that volatility, how to look at those uncertainties and go, awesome, rubbing our hands and going, let's take profit in this. Because what's happening in these events is that there's a wealth transfer going on. It goes from the rich to the righteous, and it's how to set yourself up to actually have those funds come to you. And that's the powerful thing in all of this. Here's the thing. These events are happening more frequently when you track history. There was the big crash of the 80s. Then there was the crash of the dot-com bubble. Then there was the crash of September 11. Then there was the crash of, after that, I'm thinking COVID. And then, you know, they're getting shorter and shorter, the time periods. When you start tracking them from the 1500s and medieval times, I've done this on ancient history and Middle Ages and all that, these crashes and economic crises are happening far more frequently, okay? And so the key is to be set up for these opportunities as they present, how to take advantage to receive these wealth transfers as they occur. Volatility makes most investors nervous because they've got this one strategy of buy, hold, and hope and hang on. The problem with that is the property strategy that most people have grown up. When it comes to the markets, it's a whole different kettle of fish. And that's because, of course, they also equate pain and loss with volatility. Our students are taught how to embrace volatility and potentially make huge profits from it. Let me give you an example of what some of our students are doing. And the crash of March 2020 occurred. We made our biggest profits for that year. And so did some of our students. I'll have a look at this. Daryl Cockcroft made over 200% over a number of months in 2020, just resetting his position, continuing on some gold stocks that he was trading. He loves gold. He knows gold. He worked in the gold sector through South Africa and internationally. And he gets consistent results looking at gold, copper, and silver stocks, and just keeps harvesting those positions. He said to me during that crisis, he says, I remember what you said, that you wanted to make trading as boring as possible, right? If you're looking for thrills, don't do it in trading. You know, jump out of a plane, go skydiving, do all that crazy stuff elsewhere. If you're looking for thrills in the market, you'll burn, okay, and crash. We don't want that. So with that, he says, I'm really watching my risk, but he was just continually gleaning from those falls in the market. Steve's a builder. Over that Christmas break in 2020, the 14th of December, he pulled off a 53% return on investment on an individual virtual trade on a solar company. So virtual trade is one where we tell the students we can't encourage them to do real money. We're not licensed to do that, but we do encourage them to virtual trade, to test the theories on real market conditions. And he does that. He got his second virtual trade locked at 20% return on investment over the same period as well. Not bad for those individual trades. He also pulled off the biggest virtual trade we've seen to date. If you remember GameStop, GameStop was a bunch of guys who were hearing that a hedge fund was shorting the GameStop stock. They got on social media and said, right, we're going to pump this thing up and get this thing stopped out for this hedge fund, cause some pain for them. Wall Street called foul of that. It's not fair. And it's kind of like, well, what do you mean? You've been doing this in the market for years. Well, they did this shortly after to a stock called Rocket. He caught onto it, and in 24 hours, one day on the 3rd of March, he made a single trade of 596.9% return on investment on that trade, which is huge when you think about it. All right. Now, you got to remember here that that stock only moved 70% in one day as they were doing that, which is a huge move in itself. But because he was using options, you can see the power of leverage here. His returns were greater at 596.9%, which is astronomical. In 2020, Darren turned a virtual account from $100,000 to $144,000 over that 12-month, and he was just doing it over one stock. And he just traded going up, traded going down, traded going up, traded going down, traded going up and down. He just got this result, checking every few days around his business. Busy guy, runs a very lucrative business, didn't have a lot of time. He'd just get up, check it while he was having his breakfast in the morning, off to work. And that's what he would do and adjust it accordingly. Dr. Ho Bing holds the record for the second biggest live trade with our students. That's with real money, 149% return on investment on one single trade on the 11th of May, 2021. He was actually up 300%, but he couldn't close out that trade because the market was moving so quick. So he had to settle for 149% after a few weeks. 149% on your money, it's a great result. Great result in a few weeks. I mean, when was the last time the bank gave you that much interest on your money? Yeah. Junaid Hassan, a quiet achiever of the group. I love working with this guy. He joined us in February of 2022. Before we officially started virtual trading, he was off to the races doing virtual trades. Not to the races, but doing virtual trades on the markets. And he gained 64% of a position on Apple. And then he reset that position for another 10%. And then he reset it to get them all for a 98% total return on investment. Obviously, the stock hadn't moved 98%. He just kept discipline and taking the profit, reset, taking the profit, reset, and just recycling what he was doing. On one morning, Junaid rings me and he says he'd had real money, $13,700 on a single trade, and it was now worth over $94,000. And he's asking me, what should I do? Should I take that profit? Now, because I can't give him financial advice, I'm just kind of going, well, what's your objective here? He decided to hold on to that. He would have made more money if he did. He ended up making about, I think it was $42,000 to $43,000 on that trade, which is a great result from 13,700. Would have been better at 94, but you know, who's complaining with 42, 43,000 in your pocket? He was wondering if you'd close that out for profit. Well, he did eventually, but he was having more of an investor mindset when doing that. In 2023, a mystery trader student replaced his former income with trading income. You can watch his testimonial on the YouTube channel. We don't reveal his identity because of work he's done in the past. But yeah, what he used to make in his salary, he is now getting that income from trading, which is really, really exciting for him. Are they getting large trades all the time? Frequently, they're making 15%, 22%, and set up for those large moves when they occur. And it's the discipline of taking those 7%, the 15%, the 22, 25% when they recur, and the big ones are a bonus. The most thing I'm proud of is that minimal losses have occurred, right? Over that period of time, minimal losses have occurred. They're ahead. It's money they wouldn't have had. One of our students, in a matter of months, over a period of about three to 4 months, he made in his virtual account over $30,000, just consistently taking those profits, small gains, lock it in. And that's discipline of doing that. So my question to you is how you set yourself up to take advantage of these wealth transfers, especially if they're happening more frequently, all right? How will you set yourself up to take advantage of these wealth transfers if they're happening more frequently? So we do offer a 20-week options trading course. And in that course, because I'm continually approached, hey, can you teach me how to do this? We cover these areas: mindset, which is a way the trader thinks, very different from an employee, very different from an entrepreneur. We also look at options theory. If you want to learn the game of basketball, you've got to know how to play the rules, okay? So we have to teach some theories. These are legally binding contracts. You need to understand the risk involved in that. And then the strategies. We teach about 7 to 9 strategies by the time we're done in that 20 weeks. And again, I don't like a one-trick pony. I like to basically have that so that the theory of others can be applied to those when markets change. We also look at running trading like a business. It's a very different mindset from getting a tip around the water cooler versus having a system in place to get a result. That's what a business does. It has systems and mechanisms in place to get a consistent result, to output the product or service. trading's no different. And that's what we look at when doing that. And also emergency procedures, like what do you do if your computer breaks down or the internet goes down? What if, the taxation side of things in terms of asset protection, tax minimization, how can you manage all that with systems? Then we get into paper trading and virtual trading, where we encourage our students to apply the theories they've learned to real market conditions and actually go through it and test these theories. And that's when the light bulbs go on. They see, oh, now I see what you meant by intrinsic value. Or now I understand what you meant by time decay. And we go about, as I said, about 7 strategies to 9 strategies that traders trade options for these 3 reasons: income, hedging protection, and leverage. All right. Those are the 3 reasons traders do this. So how does it work practically? What we do is we send you 2 hours of video a week to watch in your time, and then we do a live workshop for an hour to go over the material during the week. The advantage of the videos, 2 hours of that, is you can do it in your time, okay? So if you're a night owl and you're up at 2 in the morning and want to watch at that time, fantastic. If you want to do that over breakfast, 7 in the morning, you can do it. Whatever time suits you at your peak energy and level and lifestyle, you can work it around that. Then we do ask that you do show up for a live workshop, because that happens for a couple of reasons. One, that keeps you accountable to do the work. I found that students left to their own devices, they procrastinate. Oh, I'll do it next week. Oh, I'll do it next week. And they actually don't get the work done, which is not helpful. They don't learn. The other reason is they know I'm going to ask them, how'd you go with this week's workshop? Okay, so they're accountable that way. The other reason it's great is I can identify very quickly where a student's struggling. So if they're not getting a concept, we can go over that in greater detail in that hour. And I can flesh it out. I can basically review it with them. And that really helps them that hour with me. I can identify, I've been doing this a long time, over 10 years, and I can see very quickly where a student's struggling. I have found this the best method to teach this stuff. Okay, I've tried different formats. I've written for a registered trading organization that gives qualifications to financial planners, automated material. This method here works the best. I've just found it in getting you 7 to 10 years worth of experience in 20 weeks period. It just works really, really well. One of our strategies that we show is how to get a trade to a point where all the risk is gone and the trader sets you up for a free bet. And imagine if you had 10 of those set up and you just left with what I call a free bet. It's really great. You may scratch 8 of them, take some small profits, but 2 of them have great moves for unlimited profit potential. So it's getting to a place where the trader is simply trading with profit and not original capital really changes their psychology, and they relax a lot more and they can do a lot more. And the relationship to risk changes when they get to that point. And that's something that we aim to do with our students. So if you'd like to enroll in this, the course is $11,995 or $9,995 if you pay up front. So on a payment plan, $11,995 up front, we give you a huge discount of $9,995. This is a very personalized service, okay? We work with you closely. We don't take on 50 students at once in the one classroom because I don't want you getting lost in it. We will look at you very closely and what you're doing and walk you through it, okay? As I said, that's powerful. And we don't just turn you out to be a one-trick pony and charge you $6,000 for that. What we do is we give you a number of strategies and a very, as you can see, very thorough approach to how the markets work. So in my view, if you get that kind of thing, it's real value for money. A bonus, if you sign up within 48 hours of receiving this video, you'll get a free 30-minute consultation with myself to go through any questions you have on trading, an assessment at what stage of learning you're up to, and you'll receive the Trader Starting Kit free. It's valued at $369, okay? So that's if you take action and do that within that period of time. I want to thank you so much for your time. I hope you've learned a lot today. That probably would save you a number of years, hopefully, in terms of your understanding and getting a perspective of the markets. It's a little bit contrarian. If you're a bit of countercultural, you'll enjoy that, where we chase the volatility down and embrace it. Hey, if you want to get in touch with us, info@bluskyfactory.com.au. That's the way you can enroll. And I look forward to helping you with your wealth education.